The reality is traders have been using the same exact strategy for decades, so there's no denying the fact that ICT stole this from somewhere. Today, we're going to be cracking open the breaker. I'm going to show you exactly where you can find the evidence for yourself. Let's begin. Because in trading, there is nothing new under the sun. All we have is iteration or improvement upon what once existed. It's not like they update the candlesticks. They've been the same, generally speaking, since they were first invented. Our focus today is going to be structured basically on three topics: swing points, candle sequences, and how this will actually benefit your trading. The main idea that we want to get into is swing points. Let me explain. Candlesticks close on a certain period of time, right? So that's what forms these individual periods. But how they close in relation to one another determines whether or not it's a structural point of reference. So what do we have here? If we see there's a downtrend that exists, it forms a swing low. How do we know that this is a swing low? Well, you can see there are candlesticks down here, and there's a lowest candle. You have one to the left that's higher, one to the right that's higher, and then you have one at the very low. These swing points indicate potential reversals in the market. Now, the thing is, based on when those candles close and on what time frame that happens, it greatly impacts how it appears on the charts. Now, right here, we can see this is a rounded, bottom. Right here, it's similar, but over here, you get more folded action as you go up on the time frames from the 1 minute, of course, to 5, 15, 30, and then the hourly. The candle appearance changes greatly. If you were to try to classify this, you would look at the overall movement of it, right? That sequence of lower highs, higher lows, and how they shift from downtrend, right? You got sequential lower highs, and then you get these higher lows. Higher lows are going to form an uptrend. But that pivot, that point in which price breaks above that previous swing point, that's what you'd be looking at as a breaker. But what is a breaker really? Other than a sequence of price movement, meaning it goes lower, higher, lower, low, higher, high, higher, low. A lot of words, right? What is that really doing? Well, it's telling us that in this period of time, that's the path that price is traveling. And what that path looks like, depending on the candle closure, will greatly differ. The candle close sequence is as simple as this. The time that a candle closes determines how it looks, meaning a 5-minute bullish candlestick closes on that 5-minute increment. Now, what happens if that same sequence was bullish but happened 1 minute offset, right? Or maybe it was 2 minutes and it's closing in between. That if that sequence is bullish that we just talked about, what happens when that doesn't close on a perfect 5-minute, 15, 30-minute? Does that mean the price movement is invalid? Not necessarily. And that's what the breaker essentially tries to encapsulate. It's the idea that that sequence, that bullish sequence, right, where it makes that higher low that flips that previous trend line, that sequence is more than just a support turn resistance or resistance turn support. It's telling you something about the candlestick, and it just might not be happening on that specific period of time. What we see here is this. Yeah, low, low. This is the same chart from earlier. That breaker sequence where you test that higher low, you flip the trend, all it did was form a hammer. And that's the main idea that we're going to be looking at with the breaker. The bullish breaker is, in all actuality, just a hammer. And the same thing goes for the bearish scenario. What do we have here? You can see price is making, higher highs, higher lows, and eventually you see this tapering out where it's kind of topping out. You see it start to rotate. What's going on here? It's getting weaker, right? You can see definitive signs of exhaustion in the trend. You can see that market structure is starting to shift, starting to be very heavy. But you can look at this pivot right here. That's essentially what you want to be looking at. This is your higher low, and then eventually you start making lower lows. Now, this structure right here is what you look at in terms of the breaker. However, if you look at a higher time frame, what do we have here? We have a hammer at that same location. So that's essentially what you're getting when you see a breaker. You don't want to make this more complicated than it is, because I promise you, this stuff can be explained on a napkin. It's very simple. If you understand what price is doing, you can understand what a breaker is. And this is exactly how it looks when it plays out. So you see it makes that higher low. It makes these, the failed break to the upside, and then you get the displacement lower. That's a very standard play for a breaker. You're looking for something on the opposite side of the range. This is something that we actually called out. We walked this through. There's a recording posted if you want to check that out, where we go over pretty much candle by candle for this setup. And you can see that it worked out magically. Now, there is a link in my description. You can join our Discord for free. Come check out some of the pre-market streams. Check the link in the description. To continue, here are some more examples. We see strong move upward, right? You can kind of see that, price it's resistant. It does not want to go higher. So what do we do with that information? If you can look to a higher time frame, during that same period of time, you can observe characteristics of weakness. So these sequences where, price opens at a certain period of time, and then a handful of candles pass, right? Where it closes might not always be a perfect candle like that, but in a lot of scenarios, that's what the breaker is representing. So you have this swing right here, the higher low. Once you get to make a lower low right here, that now becomes an area where you'd look for it to reject. That's the breaker. The idea that was so complicated to so many people, this was stolen from a chart. It was there for everybody to see. The problem is things remain unknown until someone comes around with a name for it or someone points it out. It doesn't mean that that person did this or that. It's just a statement of fact. If someone identifies something and says, hey, look at this thing, if it's an easy to remember concept, hey, that's beneficial. If not, then just keep moving on with your day. But in this scenario, you see it plays out over and over. There's validity in these concepts, specifically the breaker, because it's simply the way that price is moving. It's not more complicated than that. There's not some magic behind it. It's just trading. It's just candlesticks. If you take your opinion out of the equation and look at what is being presented to you, you'll observe the same characteristics that I have. Now, why does this matter? You might be asking. Well, if you trade price action, I'm sure it kind of matters. If you trade using charts, I'm sure it kind of matters. Because why does a candlestick have to only be bullish if it closes bullish on a 2-minute increment? What happens if it's 2.5 minutes? What happens if it's 3 minutes? What happens if it's skewed? There's many scenarios where you might get a bullish period of 20 minutes that happens split between two 15-minute period candles. So if it's in between, it's not going to represent itself as a perfect hammer on your chart. That would be a little too easy, wouldn't it? I thought markets are complex, but no, it has to be perfectly timed on your 15-minute increment. That doesn't make sense. It could be offset. That's what a breaker basically represents. It's that period between candlesticks where oftentimes you'll see a reversal occur. It doesn't have to be perfectly set every single time. These, again, same charts that we were looking at earlier. You can see how these swing points simply look different. And we represented the idea that we saw a formation in that period of time. So with that being said, it's only fair to assume that this is something that you can carry forward into your trading by understanding that breakers are just reversals. And a reversal is based on price action. It's based on that swing point formation. If anybody has a definition of price action trading that isn't part of that, then let me know, because a breaker is the most price action based method I've ever heard of in my life. That's all we got for today. Short and sweet. Like I promised, we do not need to sit here for 25-30 minutes to go over a simple concept. So if you got something out of today's video, be sure to subscribe, like, share, leave a comment. Let me know what you're looking for next time. All right, until then, take care.